In this session, we come to probably the most common reason that traders lose money and don't survive for the long run. Now, if you've been around trading for any length of time, you've certainly heard all about this. But what we're going to try to do in this session is instead of just telling you what to do and what not to do, we're going to actually look at the underlying reasons of why traders lose in this way. And once you have that awareness, it'll be much easier to be able to apply the solutions to your own trading. So let's get into it. The number one rule in trade management is to cut your losses quickly. Now, if you remember in a previous session, we said that the number one goal in trading is to protect capital, to stay in the game. And we looked at the two major ways that traders lose. One of them was that they use incorrect position sizing. They risk too much per trade. Their size is too large given their account per trade. And a stretch of losers gives them debilitating losses. And the second way, which we are coming to now, is that they don't take losses quickly and end up with large losers, and that ends up taking them out of the game. Now, for anyone who's been around trading for a while, I don't have to tell you why it's so important to keep your losses small, right? Now, we're going to get into why you seem not to be able to do it if that's your issue. We'll get into that. But for the newer traders, the beginners, think of it this way. We've looked at position sizing in the previous sessions, right? And we noticed that if you size your positions too large and you hit a stretch of losers, your drawdown is going to get really big and you'll likely be taken out of the game. Well, even if you're using correct position sizing, let's say you risk 2% of your account per trade, which is good. It seems safe. Well, what good does that do you if you let that 2% loss get larger and larger and larger? If you remember, the way we size positions is we look at our stop in the market, right? Let's say we enter and we have a 2-point stop. We say, okay, how much will I lose per contract or per share or whatever it may be given this 2-point stop? And then I size my position according to that to give me the dollar risk that I want given my position sizing model. But the very basic assumption of that is that there is a stop loss, and when the market hits that stop loss, I'm out, and that is my loss. So 2%, I'm out there. Well, what happens if you don't go out there? Let's say you move your stop or you cancel it, wherever it may be, it's no longer 2% risk. Now, one loss can be the equivalent of 5 losing trades in a row, because if you just let it get bigger and bigger and bigger, you could lose 10% on one trade, and that's just like having gone through 5 losing trades in a row. And do that 3 or 4 or 5 times, even if you're using small position sizes, those losses rack up and you end up with a massive drawdown that you can't recover from. So this is huge, right? It's the other side of the coin of why traders fail. And if you can't discipline yourself to do this basic thing, I'm going to tell you from now, you are never going to make it as a trader. I'm going to be blunt and very straightforward. If you've read anything about trading, you keep hearing the word discipline, 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 discipline. Well, discipline, in my opinion, is not this. This should be a given. This shouldn't be discipline. This should be a given. You should respect the market so much and realize how dangerous big losses are that this should be a given. It should be just set in stone, and you should be too scared not to do correct trade management. I'll repeat that. You should be too scared not to do correct trade management. Most traders are too scared to take losses. I'm telling you, you should be too scared not to cut your losses quickly, i.e., not to keep them small and not let them get larger and larger. Because if you can't do that, you're out of the game. Plain and simple. So anyway, we'll get back to that and I'll make this point over and over. But for now, let's actually talk about why most people, most traders can't cut their losses quickly, right? What are the obstacles to doing so? So in anything, right, if the majority can't seem to do something, there has to be reasons behind that, right? Most traders lose And given that, there must be some common obstacles that are constantly tripping up most people. So, what are those obstacles? What causes people to not be able to take a small loss, to let it get bigger and bigger and bigger, even though they know they shouldn't be doing that? Well, here are a few common obstacles. The first and probably most common one is simply the need to be right. As human beings, we hate being wrong. Why do people argue, for instance? We hate being wrong. We want to be right. We want to prove ourselves right in every situation in life. Well, that's fine in the household and elsewhere, although you'd be much happier not arguing. But when it comes to trading, this simple thing will kill you. Okay? So, there's a common saying in life that most people would rather be right than happy. And the proof of this is that most people would be much happier if they just dropped arguments or conflicts, just let go, forgave the other person, and just moved on and they'd be happy. But no, they'd rather be right. They want to prove a point. So the conflict continues, the argument continues, the unforgiveness continues, and they keep it all inside just because they want to be right. Well, relate that to trading. In trading, most traders would rather be right than make money. I know that sounds crazy, but it's absolutely true. Think about it in your own trading, right? Because I'm not just talking about them, I'm talking about you and me, us, everyone. I have the exact same need to be right, right? And think about when you're trading the market. Doesn't it feel good to feel like you just predicted it correctly? And doesn't it feel bad when it doesn't do what you thought it would do? This is the need to be right in action. It creates these emotions, makes it feel good to be right, and makes it feel bad to be wrong. And so what happens as a result of this deep need to be right? Well, what happens is that when you are losing, and the market does go against you after you've entered, you end up being willing to take an unwise gamble that could result in a much larger loss than in taking a sure small loser. See, you hate the finality of a sure loser. Before you take the loser, before you let the market hit your stop loss order, or before you hit sell to get out of a long or buy to get out of a short, before you do that, you still have hope. You still have hope that you could eventually be right, that things could turn around and you don't have to be proven wrong. But taking the small loser, even though it's the correct thing to do, takes that loss from a potential thing to a certainty. And that's what we hate. We hate that finality of that. Now I can't undo it anymore. And so what do people do? They take the unwise gamble, right? They go, oh, if I wait, maybe the market will turn around. And they'll justify that, they'll rationalize it in their mind because the mind is so powerful at rationalization. We have an unlimited ability to deceive ourselves through the mind. And so we go, oh, but look at these, the indicators are lining up if we use indicators. Oh, look at this, this level could be holding. There's another level right below it that could hold. So maybe I should just let it touch that first before taking a loss needlessly. Or, oh, look, the market internals are turning around. Maybe I should keep it. It's not a big deal. It'll turn around. And all these, these all seem so convincing in real time. Once the money is on the line and you've committed, they seem so convincing. And so you either cancel the stop loss, or you're trading without one to begin with, or you move it, make it wider. And sure, sometimes it works and you feel happy that you did it. But this is probably the worst thing that could happen because it provides positive reinforcement for a behavior that'll actually hurt you over the long run. Because yes, sometimes it'll work, but for the times that it doesn't, you could be out of the game. The loss could get so big that you can't recover from it. And maybe not with one, but 3 or 4 of them, and you're out. And so that's how powerful the need to be right is. That's what it can do. Now, what's something else that's related to that that's another obstacle? Well, feeling like taking losses is a failure. See, this is related, but most people, the reason why they hate taking losses, right, is that they feel that they failed. On an internal level, they feel that they did something wrong. Not only were they not right, but they outright failed. Like they should have been able to avoid it, but they didn't. And of course, no one likes to feel like a failure. And so to avoid that feeling, what do? You don't take the loss. You stay hoping that it won't be a loss. And so because of these things, people really become risk seeking when it comes to losses. And they're usually risk averse when it comes to profits, i.e., when they have a profit, they're scared they're going to lose it, so they become risk averse and they take the profit right away. Whereas when they have a loss, they become risk seeking all of a sudden, right? And they're willing to take more risk just to avoid taking a loss. Of course, it should be the exact opposite. You should be risk averse when it comes to losses and risk seeking when it comes to profits. But that's not what most people do. Now, what's another reason that people act like this irrationally? Well, another reason is that they think that they can't afford the loss. You think, oh, I can't afford this loss, so I don't want to take it. And of course, whenever you think that way, that you can't afford to do something, you're going to do whatever it takes in your power not to do it. In reality, though, if you were sizing your positions correctly to begin with, and taking very small percent risk on your account, you can afford to take that loss. No one loss is really going to hurt you. But people seem to think that, oh, I can't afford this loss, especially if they've had a few losers in a row. And that's where those other psychological things come in. Now they're thinking, well, I can't afford to take another one. Well, you can, because your position sizing strategy and model, if you're sticking to it, will ensure that your overall drawdown should be manageable. But still, that's one of the reasons people don't take losses quickly. And another reason, which is really a hidden reason that most people don't realize, but is true, is that people are overconfident about their market reading abilities. Right? They're overconfident about them. And this isn't just, the beginners. We're all overconfident about most of our abilities, actually, not just when it comes to the market. Scientists have done so many studies over the years about people's confidence in their prediction abilities, in their skills, and any type of ability, and usually people are more confident than they should be. Now, it's funny because most people seem to lack confidence in life, right? But it's when it comes to certain abilities, especially when it comes to prediction, people overestimate how good they actually are. And when it comes to the market, this can be a killer. What ends up happening is, you enter a position, everything seems lined up in the market, everything that you're looking at, and let's say you've built up your skills and you know how to look at the market, so you're sure you're right. You just know it, right? But here's the problem with this, of being so confident. The problem is that when we believe something strongly, which is what happens when you're very confident about something, you believe it's going to move in the direction you think it will, we will find a million things in the external world to confirm our beliefs. That's how beliefs work. So when you believe something, your mind starts filtering reality to only see those things and only pay attention to those things that confirm your belief. I'll give you a quick example. If you think someone is untrustworthy, right? They're a liar, they're untrustworthy, you just don't trust them. Whether it's true or not, let's assume they're perfectly trustworthy, right? But what'll end up happening is if you, for some reason, someone told you a rumor about them, something wrong, and you now believe that they're untrustworthy, what's going to happen is your mind is going to start interpreting any little action as them being untrustworthy. And it could be just something random that doesn't actually mean they are, but your mind will interpret it and will go, oh, see, they are untrustworthy. And it could have been just an accident. Let's say they forgot to pay you back for something that you just lent them today, some small amount, and maybe they're going to pay you back tomorrow, but you were thinking, oh, they're untrustworthy. So your beliefs determine how you start interpreting it. Well, it's the exact same in the market. If you think the market's going up, you just really believe it, every little wiggle, every little uptick, you'll go, oh, see, I'm right, it is going up. You'll take it to confirm that you're right. And what'll end up happening is even if it goes down 30 points, and then reverses, you go, see, I was right. I was just a little late. You'll end up interpreting anything to confirm your beliefs. And why this is dangerous is because if you've just bought and you believe the market's going up and it starts going down, every little up move go, okay, now it's going to happen, right? So you almost feel wrong about taking your loss because you go, well, if I take it now, surely it's going to reverse. Look, it's starting to go up. So I can't take it now. Let me widen it a bit more. Let me widen it a bit more. That's what ends up happening. And you end up with a massive loss. Because the reality of the market is that it can do anything at any given time. And all the good traders believe that to their core. While they do have confidence in their abilities, they also believe that anything can happen, and they can't truly predict the market, and they never get overconfident about their abilities. They always respect the market more than that. And finally, probably the most interesting obstacle that doesn't seem like an obstacle, right? It won't seem like an obstacle, but it's trying to avoid losses. Now, this sounds funny. Doesn't it seem like you should try to avoid losses, like losses are bad? Well, let me tell you something. Losses are not bad. Losses are part of the game. If there were no losses, there could be no winners. It's as simple as that. Because if there were no losses, the probability of winning would be 100%. Everyone would win, and the whole game would cease to exist. There would be no market if everyone wins. That just doesn't work. So losses are just the other side of the coin. You have up, you have down. You have warm, you have cold. You have losses, you have wins. It's just the other side of the coin. And there's nothing bad about them in themselves. And so trying to avoid losses, having that attitude of trying to avoid losses, is a completely wrong attitude. And so we need a solution to this. We need a solution to all of these things. Because if you let them just go unaddressed, they will cause major problems and you won't cut your losses quickly, and you'll soon find yourself out of the game. So in the next session, we're going to get into the solutions and the outcomes once you have taken those solutions to heart and started implementing them in your thinking and in your trading.